Hi, I'm Robert Maltbie. Welcome to Maltbie's Minute on the Market. Summer's gone with the great coronavirus tech rally looking to have hit a glass ceiling finally. And as the days get shortened, the temperature drops and the leaves turn brown. We're shifting possibly for a great rotation from the multiple high-tech stocks into small caps and values, big cap value. The difference in valuation is stunning. The Nasdaq trades at about 70 times earnings, whereas the microcap, Russel microcap index trades at about 12 times. Huge difference, historical epic proportions. So we're going to cover our market update and strategy, what's going on now, and a little bit about Robinhood, and a little bit about our conference, a tremendous conference coming up later this week. So let's get into it. Our market sentiment is bullish. The Robinhood Nouveau traders chase stock splits in Tesla and Apple, running the Citi Group Euphoria Index to overheated levels. The bull-bear ratio remains in bullish territory. That's the AAII. In contrast to the Euphoria Panic Citigroup model, which is more reflective of retail sentiments. The bears outnumber the bulls in the AAII. The contrast is the pundits, the institutional investors in the AAII are more reflected, and they've been more conservative. The risks in the bond market is showing some spreads, and the put-to-call ratio is fairly bullish on the S&P 500. That's the backdrop we have. Moving on, the technical indicators are bullish. After the drop, the sell-off of about 10% in the Nasdaq, right down to the moving averages, holding support here. Liquidity indicators are neutral. This is a bit of an enigma in that the lack of positive flows into equities, ETFs, and equity mutual funds is a head scratcher somewhat. And the constant outflow from them, about 20 billion last month, into bonds. But money market funds remain huge at $4.4 trillion, about 13% of the overall equity market. Should serve to sop up the downside here, and also the anticipated large IPO calendar coming to the market of about over 20 billion as that motor turns on again. Earnings momentum negative, but shaping positive. We've had our first rollover to a positive quarter in a while. S&P earnings next year call to a return to $160 level. Valuations are neutral to negative. A few indicators we look here, focus on here, the market cap to GDP at 1.75 is slightly below the excesses reached in the year 2000 of 2.3. The market cap to replacement value, better known as the Tobin Q, is 1.2. That's indicating that the values, the replacement values, are much lower than the prices right now in the market. The corporate bond yield is positive. This is the positive indicator at 1.2 times, and it supports a much higher multiple, about 27. If you combine that with even this year's depressed earnings estimate on the S&P of 125, we get about 3,400, about where the S&P is now. So looks like fair value. Monetary indicators, this is kind of the battleground right now, is neutral. Waiting for a stimulus bill, kind of stuck in neutral. If we don't get it, I would expect some downside. In the valuations between the large cap growth and the small cap Russell 2000 are huge, about a 40% difference. Premiums in the big caps, and that's close to the year 2000 levels. The question is, what will change this? And we think it will be a stimulus, emergency stimulus package that will help get this rolling, combined with a vaccine showing visibility on the end to the virus. But let's talk about that merry man who takes from the rich and gives to the poor, the upstart millennial brokerage firm, shall we call it, Robinhood. Some negative press out. Seeking Alpha came out with a piece slamming it for not being so egalitarian. They seem to group their orders and send a lot of that trade flow to high frequency traders, where the founders originally started making systems to help high frequency traders get an edge, and it looks like they're directing their trade flow there. Some of the clients are a little bit interesting. Citadel was fined $22 million by the SEC for violations in 2017. Two Sigma has had run-ins with the Attorney General in New York, and also Wolverine Securities paid $1 million fine for insider trading. So there are some of the high-frequency trading clients that are getting a lot of the flow from Robinhood. New York Times takes that a little bit step further and shows the difference in terms of the profitability, combined with a focus on really a brokerage functionality that's like a video game, and very addictive, very easy to use, and they encourage leverage and options. So very, very high risk, high turnover, high commissions, and they out-yield their competitors by about a 10-to-1 ratio in terms of what they get paid on the flow to the high frequency traders. So maybe they're more like Bandithood or Al Capone or John Dillinger. And it's kind of the iceberg strategy, where the real damaging part doesn't meet the eye, meaning the young millennials go, hey, we're not paying a commission, but the order flow is being directed in a nefarious fashion, possibly, that is much more expensive. Now let's talk about our upcoming conference, which is Thursday. By the time this gets out to press, you can audit the conference on the internet at singularresearch.com. A little bit about it. I'm very excited about it because I own every single stock of every company that's presenting. So you know that I like them. They're covered by our research department. So we focus on small caps that lack coverage, known for our performance-based research, and it has outperformed the S&P 500 by 400 basis points since we incepted 16 years ago. With the Nasdaq and the S&P a little bit bubblicious and deflating, with the Teslas, the Apples, the Zooms, and the Salesforces getting hit pretty hard in the last week or so. The high-tech darlings of the market are finally coming off and likely headed lower still. We think there couldn't be a better time to take a careful look at 15 quality small cap value stocks that have valuations that are quite engaging, at roughly a 50% discount to the market, the S&P 500. We're going to feature a couple companies. One is that I'd like to talk about of the 15 in the interest of time. Two of my favorites. A major New York Stock Exchange traded bank, trading at 12 times earnings at a 40% discount to book value and a 6% yield for your time while you wait for this appreciation. And biotech trading at less than 20 times our estimate for next year, and collecting huge government checks as a top global drug company racing toward as supplying global drug companies with the labs and the personnel they need to race towards that solution for COVID-19. And many more stocks. But a little bit more about this company. It's called Emergent Biosolutions. We picked up coverage over 3 years ago. The stock was in the 30s. It's now 100, down from 135. We think this sell-off provides a good entry point. We have a $144 target. Product sales improved 63%. They were, again, they're a major player in the COVID-19 vaccine space. They were awarded a $628 million task order by the HHS for the production of helping the vaccine companies. They have Johnson & Johnson, Novavax, and Vaxart in their stable of high-profile, quality biotech companies. And we've recently increased the earnings estimates as they've smashed through it, looking for over $7 a share next year. So it looks reasonably priced at about 15 times earnings, with a lot of growth ahead. So in summary, come visit our website for complimentary reports and research at singularresearch.com, and also register for our upcoming compelling values, focusing on the companies we've mentioned. So looking for further upside in a fairly valued market and a great rotation from the high multiple stocks into the value stocks. I'm Robert Maltbie. This has been Maltbie's Minute on the Market.